What's up, guys? Welcome to the channel. With the Federal Reserve continuing to raise interest rates, there is a possibility for there to be a recession in the year of 2023. So in this video, I'm going to be reviewing 4 of the top recession-proof stocks. So let's get right into this. Starting off at number 1, I have PepsiCo, currently trading at $181.10. In the last year, this stock has risen 4.16%. In the last 5 years, it has risen 53.37%. And in the last 10 years, it has grown 155.5%. This stock is performing very well over the last 10 years. Now, let's look at Pepsi's dividends. You can see they have a starting yield of 2.6%. A payout ratio of 66.92%, which is a little high. However, Pepsi is one of those stocks where they're not really investing that much of their money into new products. They're pretty much set with what they have. So that is a fine payout ratio. And then they have a 5-year growth rate of 7.39%, which is a great rate. I always say if you can get 7% or more, that is where you want to be, because a 7% growth rate means your income doubles in 10 years. And then next, they've been growing their dividend for 50 years, which also makes them a dividend king. So I do want to go over to their financials real quick and just show you that their revenue has increased year over year, which is great to see. And then also their net income has also increased year over year. You can see that in 2019 it dropped from 12.5 billion. However, from there it's still trending upwards. And then next, their balance sheet. Just wanted to show you their last reported cash and equivalents is $6.4 billion. And then I scroll down to their total debt, 39.2 billion, and then their net debt, 32.5 billion. So that is about 20% or more that they can pay off of their debt. And then for this company, I'm not worried about their debt too much because I know that they can pay it off. Then let's look at some information. Why is Pepsi recession proof? So let's look at their competitor, Coca-Cola. And this is saying that Coca-Cola has a higher market share in what they call away from home channels, like restaurants, theme parks, movie theaters. And so Pepsi actually has less exposure to these more expensive channels, and that has affected it less during recessions. So during 2020, Coca-Cola's revenue decreased by 11.4%, while Pepsi's increased by 4.8%. And this outperformance is due to Pepsi's snack segment, where people stayed home and ate more snacks. So the crazy thing about Pepsi is that you may think it's a drink company like Coca-Cola or a beverage company. However, this is a snack company. Over 50% of their revenue comes from their snack line. Next up on the list, we have Waste Management, which is currently trading at $159.49. They're down 2% on the year. They're up 81.88% in 5 years. And they've grown 358.17% in 10 years. So let's check out their dividends. As you can see, they have a starting yield of 1.69%, a healthy payout ratio under 50% of 45.5%, and then a great 5-year growth rate at 8.87%. And they've been growing their dividend for 19 years. It won't be long before this company is a dividend aristocrat. And then let's go to their financials. As you can see, their revenue has grown year over year. And then as well as their income has also grown year over year. They had some down years, but it's overall trending upwards, which is what we like to see. Then next up, look at their balance sheet. You can see that their cash and equivalents is pretty low at 137 million. And then if we look at their debt, see they have 14 billion in debt, and pretty much their net debt is 14 billion. So they're only able to pay off $100 million of their debt. But because Waste Management is such an essential company, I'm not worried about their debt. And just to give you guys an example, the waste company that picks up at my house is called Waste Connections. And about 6 months ago, they increased my bill by a whopping 37%. So with these waste companies, they're able to price their services however they want. And now let's dig into Waste Management a little bit. Their collection services contributed to more than half of their revenue in 2019. Other sources include transfer, landfill, recycling, and other. So the collection revenue comes from a wide variety of sources. This helps them ensure that declines in certain sectors of the economy don't crash their revenue stream. And this shows you that when their commercial collection revenue fell by 11.8%, their residential revenue actually increased, even though their industrial collection revenue decreased by 16%. So Waste Management proves that the business can handle widespread slowdowns in the economy. Now, next up, we have Procter & Gamble, which is selling for $153.92. They're actually down 5.47% on the year. They're up 69% on the 5-year, and they've grown 122.36% on the 10-year. Now, if we check their dividends, they have a starting yield of 2.43%, a payout ratio of 61.81%, which is a little high, but for this company, which sells essential products, I'm not worried about this payout ratio. However, they do have a low 5-year growth rate of 5.68%. However, they have been paying their dividend for 66 years and growing it for that long. So I'm not worried about that low growth rate because this is such a stable company. Then if we look at their financials, over the years, their revenue has been growing. And then if we scroll down to their net income, once again, their net income has also been growing over the years, which is great to see. Then we check their balance sheet. Their cash equivalents are currently at $6.7 billion, and their total debt is at $33 billion, and their net debt is at $26.29 billion, which means they can pay off a significant portion of their debt if they need to. Now let's see why P&G will roll through a recession. So Procter & Gamble has been around since 1837. It survived the Great Depression. It survived many years of inflation. It survived multiple recessions, and it's even survived war. So that's one reason why Procter & Gamble will not struggle during a recession. And then let's look at their brands. As you can see, baby care, even during a recession, you're going to need diapers. Right now, I'm currently using Pampers. And then we have fabric care. You still have to do laundry during a recession. Family care, you need paper towels, definitely need toilet paper and facial tissues. Feminine care, that does not go away with the recession, neither does grooming. Then you have hair care, home care, and so on, oral care, all this stuff that you need to buy during a recession. So last up on the list, we have Costco, which is currently trading at $482.87. And now they're down 12.17% on the year. And they're actually on the bottom half of their 52-week range. So I'd say now might be a good time to get Costco while it's down over 10%. But on the 5-year, they're up 165, almost 166%. And on the 10-year, they're the top performing stock on this list, up 431.14%. So everybody's always looking for the perfect time to buy Costco stock. Why not buy it now? So let's look at their dividends. Costco is one of those companies with a low starting yield. However, they have a low payout ratio of 26% and an amazing 5-year growth rate of 12.35% and dividend growth for 18 years. So pretty soon, This stock too will be a dividend aristocrat. Then let's look at their financials. Their revenue has also increased year over year, and in some cases significantly from 2020 to 2021. And then their net income has also increased year over year, which is what we like to see. Then if we check their balance sheet real quick, their cash and equivalents actually have 10.8 billion, which is amazing for a retailer. And then if we look at their total debt, it is 9 billion, and their net debt is negative 2.6 billion, which means Costco can pay off their debt right now if they want to. So this is a very secure company, which is what you want to see going into a recession. Now, let's look at why Costco will perform well during a recession. So Costco is likely to fare better than other broadline retailers. That's how it's performed historically in past recessionary periods. Its high margin stream of membership income provides stability, and a more challenging economic times will strengthen its appeal to customers. So a couple facts about their membership. As it said, it's a high margin, and because of that, during a recession, people will want to shop at Costco more to get their money's worth from their membership. And another thing, if you remember last year in 2022, through the high inflationary period we had, other big retailers like Target, Walmart, and Kroger stumbled through the inflation by having more inventory. However, Costco's management performed much better than all those other retailers, and that is why I chose it as my last top recession-proof stock. So guys, thank you for watching the video. Remember to like the video and subscribe for more investing content, and get your free stuff below. Links in the description. M1 Finance, Webull, and check out my Amazon links below.